For more on the tech startup scene in China, I'm joined by Max Wolff. He is the market strategist at 55 Capital Partners. Always a pleasure to have you on the show.
So great to be here. Thanks for having me back.
You bet. Well, let's talk a little bit about the startup scene in China. It has 35 tech startups valued at least $1 billion US. So it places it second only to the United States in terms of so-called unicorns. But a lot of them hit the $1 billion mark only as of late 2014. Why so late? And is that worrisome?
Yeah, so thanks for having me. Great to be here. At 55 Capital, we try to divide the world more by macro trend. And one of the big trends is the future of the internet is in the emerging market space, and no place is more advanced, no place is more setting the pace or determining the taste of the emerging markets than China. So I think what we see here is that the big private companies just coming public now, they may have been out of Silicon Valley at first, and there's still quite a number there, but the Chinese internet is growing up fast, already a lot more users, even more English language users in China than here in the United States. So really only India is a rival for size. And what we're seeing is every day that passes, we get more sophistication and a larger market in China. And for e-commerce, for online, for subscription driven, we know China is the future, catching up fast. And I think we see that in the valuations with a whole lot of these about to go public unicorns out of China as well.
Is it worrisome though that the majority of them have reached that unicorn status only as of 2014?
It's a bit worrisome, but let's be honest here too. The last 3 or 4 years, we saw a real topping process in valuations of almost all risk assets around the world. There was a sort of gorging on anything that looked risky, and an effort to get returns, because the returns people could really get with traditional safe investments were really poor, right? And so they tried to do something different. And one of the things they did different was buy tech stocks, just as true in California as it is in China. So it is a bit worrisome, but not unique to the Chinese story.
Okay, well, we've seen that tech stocks have really sold off here in the United States since we've got President-elect Trump coming into office, particularly the so-called FANG stocks. Does that bode not so well for Chinese tech companies, this sort of the markets reacting to the news?
It's a great question. We sort of see it as less likely to be a problem there because the Chinese internet economy is a little bit its own thing, right? So the big American tech companies usually try to conquer the world. The market is so big and somewhat unique in China that the big Chinese tech companies mostly conquer China. They then spill out. We've seen that with Alibaba and Tencent and Baidu and the big names. But the Chinese market is a lot to explore. It's growing super fast. It's very dynamic. They have a little bit of insulation. And part of the sell-off in the US is we're seeing people leave what worked before Trump and try things that didn't because they think it'll be different, one. Two, the truth is when you buy a tech company, particularly an aggressively valued or startup company, you're buying a vision of the future. The better your investors feel about their future, the more likely they are to ante up for it. I think the Chinese average investor feels pretty good about China's future. I think there's some nerves about the future of American tech companies in the US, maybe particularly given that Trump was pretty aggressively critical of American tech companies as a candidate. So I think the situation is somewhat different and differential.
Okay. Well, as you mentioned, a lot of interest in Chinese tech companies domestically. So is really the infrastructure, the investment, the VCs coming from Chinese investors or foreign investors?
So I think it's a bit of both. I think foreign investors would love to get more exposure to Chinese names. I think they'll be able to in the future. But I think the other thing we're seeing here is that the big Chinese dominant internet companies, your Baidus, your Alibabas, your Tencents, they're pretty excited about making pretty aggressive acquisitions globally, but definitely at home. So we have an ecosystem dominated by a few large players in the US. And I don't think it's totally different in China. So you see your JD.com and some of the other names and Weibo, which is interesting. But some way or another, those three big dominant BAT companies, what they call BAT, so Baidu, Alibaba, Tencent, tend to have some interest in most of the names, and we don't see that changing.
Okay, well, in terms of bubbles, though, because there's been worries about the level of debt in China, and we've been talking about how the real estate market might be overvalued. Do you think there's a potential that there's a bubble in the startup market as well in China?
Sure, whenever you see interest rates kept pretty low and you see a sort of mind on stimulation and a desire to keep people engaged and employed, there's some risk that you overstimulate. But I don't think that the Chinese situation is vastly different than other situations in terms of tech. That being said, all over the world, multiples have gotten a little out in front of their skis. And we really, in terms of tracking the risk, we have proprietary risk tracking in-house, and we have something called the 55 Capital MRI, or Market Risk Index. And we feel like it's telling us an orange light is flashing. We should be kind of careful globally, true of China as well, but in no way particularly true in China.
All right, Max, thank you so much for your insight. That was wonderful. That was Max Wolff, market strategist at 55 Capital Partners.